Good afternoon, everybody. We're going to wait about one more minute to let everybody else who's in the waiting room get into the webinar. Good afternoon, everybody, and welcome to the latest episode of the Stowe Degon webinar series. I'm Marty Croyle, a partner at Stowe Degon, and today, thankfully, the election has been over for 2 weeks, and all of the political campaigning and advertisements are over, and now we're here today to talk about the income tax and estate tax fallout from the election. Next slide. We have assembled a great speaker group. You all know Prasanna. He is the head of our tax department at Stowe Degon. Mary Donati is a senior manager in our tax department, and she's also presented before. But today we have a special guest, Rob Aroni, who is a partner at the law firm of Orsi, Aroni, Rothenberg, Turner. And Rob's firm and Stowe Degon, we're great friends, and we work together often. And Rob is going to be here to be an expert on estate tax changes as 2025 comes along. Next. Couple of rules and regulations. We ask for any Q&A you can find. You'll find a place to put that in the Q&A box at the bottom of your screen. Put your questions in, and we'll answer as many of them as we can during this webinar. If we can't answer all the questions or we don't know an answer today, we'll get back to you. Secondly, the program is being recorded, so you don't need to make copious notes. You'll also be able to look at this webinar again if you want to refer to it or share it with other people in your company. After the webinar, we will provide you with a short survey. We appreciate you taking a minute to fill that out. It continues to tell us here at Stowe Degon if we're doing a good job, and also asking you for suggestions for future webinars. Disclaimer, today is November 19th, 2024, and all the information you're hearing today is the best information that we have as of today. But as you know, things change. And in the tax world, they change all the time. So if you're ready to make some big decisions, please contact us at Stowe Degon to help and not just rely on this webinar. Again, things do change. Today, for the next 35 or so minutes, we're going to talk about these 4 topics. Prasanna is going to handle the first 2, the Trump proposed tax reforms and business planning. And Mary's he's then going to pass this webinar off to Mary. She's going to talk about tax planning ideas for individuals. Mary will then turn it over to Rob, and he'll talk about the estate taxes. And then Rob will turn it over to me, and we'll handle Q&A. So Prasanna, take it away.
Thanks, Marty. My name is Prasanna Kirambi. I'm a tax partner here at Stowe Degon. First of all, I wanted to thank everyone for taking the time to join this webinar. Second of all, everything that we talk in this webinar is going to be in general terms. Everybody's tax situation is different. Fact patterns are different. So please don't take any decisions based on what you hear in this webinar. Please do give us a call, and we should talk about it before you make any decision based on it. To start with, we figured one of the things that everyone would be curious about would be what are the Trump's proposed tax reforms. When the Tax Cut and Jobs Act was initiated around the end of 2017, Trump had initiated a number of changes. Though some of the changes, like reducing the corporate tax rate from 34% to 21%, was permanent, there were a few changes that were temporary, and a lot of those changes are supposed to expire at the end of 2025. One of them was reducing the highest individual tax rate for individuals from 39.6% to 37%. He doubled the standard deduction from around $12,000 to $24,000. The child tax credit was doubled from $1,000 to $2,000. They also put a limit on the state and local tax deduction at $10,000. The estate tax exemption was doubled to currently around $14 million per individual. They also increased the alternative minimum tax exemption amounts, the phase out thresholds. One of the deductions that a lot of our clients benefit from is the 20% qualified business income deduction. All of these are supposed to go away at the end of 2025. Last week, it became official that Republicans have not only flipped the Senate, they have control of the House as well. And they have what is called the trifecta. So, what does that mean from a tax perspective? One of the things to keep in mind is that Republicans only have a slim majority in the Senate. They only have 53 seats. They don't have a 60-seat majority, so they're not going to be able to overcome a filibuster. The founding fathers, in their infinite wisdom, did intend the legislative process to be a slow process and a deliberate process rather than prone to whims of lawmakers trying to score short term political points at the expense of long term welfare of the country. So, any bill that does get passed has to go through a reconciliation process. What does that mean? A reconciliation bill cannot increase the federal deficit beyond a specified budget window. Usually it's 10 years. If the tax cuts are expected to reduce government revenue, they must either be offset by spending cuts or revenue raising measures to ensure that the overall impact is deficit neutral within the budget window. So, if the president wants to extend the provisions of the Tax Cut and Jobs Act that we just talked about, they're going to need to find around $4.6 trillion as a part of the reconciliation process. Trump also has a bunch of other tax cuts that he would like to initiate. Reduce the corporate tax rate to 15% for domestic manufacturing. If that happens, that might maybe in a C Corp might be a better structure for a lot of our clients as compared to S Corps. He would like to eliminate taxes on Social Security benefits. You'd like to eliminate taxes on tips and overtime payments. He wants to increase the child tax credit from $2,000 to $5,000. He wants to initiate new deductions like deducting interest paid on auto loans and bring back 100% deduction on R&D expenses and capital investments. My understanding is that you would need around $8 trillion to initiate these tax cuts. In order to find $8 trillion, they would have to start the reconciliation process pretty early. Next slide, please. As we talk about, in order to pass these tax cuts, Trump will not only have to cut down wasteful expenditure, which is where the new Department of Government Efficiency comes into play. I'm definitely interested in seeing what are some of the things that Elon and Vivek recommend. But besides that, what are some of the things that Trump is thinking about in terms of raising revenues? The first thing is the universal baseline tariff. The universal baseline tariff is a policy proposal that involves a flat across the board tariff on all imported goods into a country, regardless of their origin. Trump has proposed a 10% universal tariff. The Tax Foundation estimates that such a tariff would raise approximately $2 trillion from 2025 through 2034. Of course, this is true if the import levels do not go down. We would still need $6 trillion after that to be found as a part of reconciliation. A 20% tariff would raise $3.3 trillion instead of $2 trillion. If they got rid of Biden's Inflation Reduction Act, which would get rid of a lot of the solar type credits, that would generate an additional $900 billion. So, in other words, there is still a lot of work to do in order to make sure that Trump is able to initiate a lot of these reforms and a lot of these changes that he wants to do. Um, so I do believe that he can impose tariffs outside the reconciliation process, but if only if there is some sort of an emergency. But so anything that he does would be a temporary measure. So it would make sense to do it all as a part of the reconciliation process. We'll obviously keep our ears to the ground and keep everyone well informed if something new comes along with regards to this topic. Next slide, please. Next slide. Let's move on to the next section where we can talk about what do businesses have to think about before the end of this year. There's not a whole lot of legislative activity that has happened in the last year due to gridlock, so not much has changed from prior year. So some of the things we'll talk about today, we've covered in the previous webinars, but we'll talk about it nevertheless. The first thing is corporate rates for C Corps continues to remain at 21%. This was part of the permanent change. This is not set to expire at the end of 2025, so this will continue as we go along. The profits of the flow-through businesses will continue to enjoy a qualified business deduction of 20% for 2024 and 2025. Just as a quick refresher, what is this qualified business income deduction? When the corporate tax rates were reduced from 34% to 21% for C Corps, they wanted to do something for flow-through businesses as well, which is the S Corps and the partnerships. So they came up with this 20% deduction. What this essentially does is if you have an S Corp, you made $1 million in that S Corp, it flows through to your individual return. Instead of paying tax on the $1 million, you get a $200,000 qualified business income deduction subject to some other conditions being fulfilled. So you pay tax really on the $800,000 instead of the $1 million. So the other question that people ask us a lot is about where are the depreciation rules right now. In terms of Section 179, the maximum 179 that's available right now for 24 is $1.22 million. This deduction starts phasing out once the total assets placed into service during the year exceeds $3 million. For SUVs that are over 6,000 pounds, the maximum 179 deduction is capped at $30,500. The bonus depreciation is going down from 80% in 2023 to 60% in 2024. So the depreciation from a bonus standpoint is going to be slightly slower. Businesses are allowed to use cash method of accounting for tax purposes if their average annual gross revenues for the previous 3 years is less than $30 million. So if you got to look at years 21, 22, 23, and if your average gross revenues is less than $30 million, you can use the cash method of accounting for tax purposes as opposed to accrual method. Next slide, please. Section 174, we were talking about this reconciliation process earlier. When the Tax Cut and Jobs Act was passed at the end of 2017, as a part of the reconciliation process, one of the rules that was set up was to amortize R&D expenses over 5 years period from 2022 onwards. Nobody thought this would stick and the government would eventually fix it. Even the IRS didn't think it would stay, and they didn't issue any guidance on it for over 3 years once it was issued. However, this problem has still continued to persist because of gridlock in Congress. We're going to go one more year with the R&D expenses being amortized over 5 years and foreign R&D expenses being amortized over 15 years. Hopefully, with the tax reform or tax changes that comes up next year, this problem will get fixed. Next slide, please. Tax planning opportunities, without getting into too much detail because everybody's tax situation is different. Cash versus accrual is something that should be looked at if the business has changed and if one method is better as compared to the other. Sometimes changing the method has a favorable impact. When you change a method and you have an unfavorable change, you're allowed to pick up the income associated with the unfavorable change over 4 years. But if you have a favorable change, you get the benefit of the change right away. We always tend to look at clients to see if there is any change in their business, if accrual versus cash, what makes more sense, and see if there is any tax savings or tax opportunities out there. Accelerating income items or deferring income is dependent on obviously everybody's tax situation. In terms of retirement plan, this was put into place by Secure Act 2.0 to incentivize smaller businesses to provide retirement plans to its employees. They not only have a credit for costs incurred in setting up the plan, but they also provide some credits for employer contributions into the 401k plan. Next slide, please. The standard mileage rate is around 67 cents per mile for 2024. The IRS has not still announced what the mileage rate is going to be for 2025. The next bullet talks about different types of credit for solar panels. But one simple way to think about it is if you have a commercial property and you have a good roof and you spend $100,000 in putting up a solar panel and they are placed in service in that year, you get a $30,000 credit right away. So now your basis in the panel is $70,000. Instead of depreciating $70,000, you get a kicker for $15,000 and you get to depreciate $85,000. This $85,000 can be depreciated in year one through a bonus depreciation, which is right now at 60%. So you almost get a 50% return in ROI in the first year if you kind of put solar into play, solar panels, or if you're using solar in your commercial property. You never know how long these credits will stay on with the whole reconciliation process that'll go through next year. So something to keep in mind if for 2025. Next slide, please. Nothing has changed as far as NOLs are concerned. The net operating losses cannot be carried back for corporate purposes. It can only be carried forward. And if you have income in a particular year, you can use your net operating losses to only offset 80% of the income. So if you made $100,000, you can use losses up to $80,000. So you still have to pay some tax on the remaining $20,000, even if you have losses greater than $100,000 to offset all of the income. Next slide, please. The next slide talks about the pass-through entity tax. Again, this has been in place for a couple of years now. When the Trump Tax Cut and Jobs Act was passed, one of the provisions in there was a $10,000 limitation on state and real estate taxes for individuals. So people no longer got the benefit of deducting state taxes on their federal tax return. So in order to circumvent that, the states came up with this pass-through entity tax concept. So for example, if you made $100,000, or let's use $1 million instead. Let's say you made $1 million in the S Corp. Normally what would happen is that the $1 million would flow through to the individuals and they would pay $50,000 at the individual level in Massachusetts. Now what Massachusetts says is that instead of paying us $50,000 at the individual level, pay us that $50,000 at the entity level. So now your federal taxable income, instead of being $1 million, is $950,000. So you kind of save some money on the federal taxes by doing that. A lot of our clients, we've talked about this in the past, a lot of our clients are already taking advantage of this. If you'd like to talk about it, please let us know. We can obviously walk you through it. Next slide, please. The next slide is a more legal issue than a tax issue. The Financial Crimes Enforcement Network came up with this beneficial ownership information reporting. We talked about this last year. I'm sure you've heard it from your attorneys and different people with regards to it. What they are asking you to essentially do is report for small businesses with less than $5 million in revenue and less than 20 employees who your beneficial owners are, if they own more than 25% or have substantial control of the company. If you set up a new entity in 2024, you have to fill out this form within 90 days. For all the other existing businesses, this needs to be done before December 31st of 2024. I've done this form a couple of times, so it's pretty easy to do. All you have to do is go into their website and fill a form which provides the name of the entity, the name of the beneficial owner, the address, social security number, and scan in a copy of the driver's license. Though I encourage everyone to do this on their own because it is pretty simple. If you do need assistance on it or have questions on it, please feel free to give us a call. With that, I'll pass it on to Mary. Mary is actually our go-to person on the beneficial ownership information reporting form. So Mary, if I missed something, please feel free to add to it.
The only thing I would add is it is supposed to be very easy to fill out. FinCEN's website has a wonderful tutorial of how to go about filling it out. It really is self-explanatory. It's just a matter of being able to take the time to do it. So with that said, we're going to move on to what's happening in the world of individual taxation. And we can move on to the next slide. Yeah, so there's really nothing major taking place in the 2024 year to really talk about. The one change that I thought was quite beneficial to all different types of taxpayers is the fact that starting in 2024, the 529 plans can be rolled over to a Roth. Now, before you run out and do this, please talk to us or your investment advisor, because there are rules and regulations that determine which 529 plan will qualify to be able to be rolled over to a Roth plan. And it has to do with how long that 529 plan has been open, when your last contribution to the plan was, when your first distribution to the plan was. But it's a wonderful opportunity for plans out there. They're just sitting, your child or yourself have finished your education, you're sitting with funds in that plan. You may be able to roll over to a Roth. So touch base with us or your investment advisor. We can move on over to the next slide. This is just the 2024 tax bracket. Nothing really has happened here except for about a 5.4% increase from the prior year due to inflation. On to our next slide. We have here the tax brackets for those of us who have qualified dividends or long-term capital gains. Once again, only thing that has changed is about a 5.4% increase due to inflation from the prior year in these brackets. We can move on over to the next slide. Cryptocurrency, it's something we talk about year to year. I know a couple of years ago, I probably did too much of a deep dive into this, but please do know that the IRS does scrutinize this, and that's why we keep bringing it up. We can move along to the next page, and this is one of my favorite things to harp on. When a taxpayer touches base with me and say, hey, what can I do to reduce my tax? The first thing I say to them is send me over your paycheck stub. And I just really cruise along reviewing it. And I always focus in on the 401k contribution. This is the easiest way to reduce your taxes. Let's take, for instance, that you have a 401k plan at work. You're over 50 years old. You're in the 32% bracket. You're able to make a contribution of $30,500 for the 2024 tax year. That's a tax savings of about $9,760. Well worth doing. So tax planning, make sure that you fund your retirement plans. It is the easiest way to reduce taxes. Now for 2025, there's some excitement going on in this area for those in the wonderful age bracket of 60, 61, 62, and 63. Starting in next year, there's an additional catch up for those of us who are in that age group. I'm not quite there yet, but for 401k, if you are in that age group, you can put away an additional $3,750. Simple plans have an additional catch up for that age group of additional $1,750. And the reason why they are doing this is they realize Americans aren't saving for retirement. But if you notice, I did not say anything about IRAs. They did not extend this extra provision to those of us who only have an IRA account. And that's why if you have a Schedule C company or an S corporation and you have not set up any type of plan for these, you may want to touch base with us. This is the perfect time to be setting up a simple plan, 401k plan, or a SEP IRA plan for your Schedule C accounts. Next slide, please. Okay, charitable contributions. This is one thing we talk about every year. This is an election year, so I just want to throw this out there. There are many people have probably donated to their favorite candidate's campaign fund. That is not a tax-deductible contribution, unfortunately. We can move along to the next slide. So there are many ideas of ways to reduce your tax taxes, things that you should be looking to do before the end of the year. These are many things we discussed about in previous year, but there are a couple of things that I want to focus in on. And one of those is make sure that you take your required and minimum distributions if you have an IRA, annuity, or any other type of plan, and then you are subject to these required minimum distributions. Because if they are not taken, you could be subject to a penalty. And along this line, we are recognizing that a lot of individuals have inherited IRAs and annuities from their parents. There may be an obligation on your part to also take an RMD from these inherited accounts. So please reach out to us to discuss these with us or your financial advisor, whether you have an obligation to take an RMD from an inherited IRA. It is now is also the time to be reviewing your portfolio. If you have realized capital gains, this is the perfect time of the year to talk to your investment advisor about harvesting capital losses to offset those capital gains. Just keep in the back of your mind the wash sale rules. If you really like a position, you cannot rebuy that position. You just sold at a loss for about 31 days. Otherwise, that loss will be suspended. Crypto losses don't have the wash sale rules apply to them. So if you're sitting with a loss in your crypto account, sell it, buy it back within a couple of minutes. We're going to move right along to the next page. Fraud. It is happening. That's all I can say. I have been recently a victim of identity theft to the Harvard Pilgrim hack, and it's a non-stop process of people just going after your identity. That's all I can say. But what you can do from a tax perspective is apply for an IP PIN. And what this does is the IRS provides you with a 6-digit PIN that changes every year, and it works. And then what it does is you cannot file a return electronically without this PIN. And like I said, it really does work because we go file a return and it needs a PIN, it will bounce. So consider obtaining a PIN. There are all kinds of other things that can be done to protect yourself from fraud. You are the only person that will protect yourself from fraud. Nobody else will. And one of the easiest, of course, things to do is to have strong passwords. Cannot say anything enough about strong passwords. Let's just take quickly, just a quick fact out there. A character password with just digits can be hacked in 57 seconds. If you add numbers and alpha to that 8-digit character password, 57 days. I've recently been in a seminar and they're recommended 14 characters for a really nice strong password with numbers, letters, and symbols. It takes about, they say, 100 years to hack. So these are just ideas. If you have been a victim of fraud, identity theft, please reach out to us. We can help you what you need to do, especially when it comes to taxes. On to the next page. I'm not going to go into this. It's been covered. The Tax Cuts and Job Acts will be expiring. What will happen? We'll see what Trump does within the next couple months. On to the next slide. Residency changes. We are a mobile society. This is happening more and more. People are moving from state to state to state. Just know that moving to a new state does not make you a resident just by buying a property or renting a property and changing your driver's license. There are many other things that you need to do to really officially make that new state your home state. So please reach out to us to make sure you have dotted your I's and crossed your T's. We're going to move on to the next slide. Massachusetts has started a tax amnesty program just a couple of weeks ago. It's not just available for individuals, available for corporations, payroll tax, and a host of other taxes. So if you find that you are behind filing various tax returns, please reach out to us. We can try and get you up to date and apply for tax amnesty for you in the state of Massachusetts. We're going to move right along. here to our last slide for individuals. Not much going on in the state of Massachusetts. There's a new withholding requirement on the sale of property for non-residents. The law has passed. They're still working out the details. But this is not surprising, knowing that other states have this in place already, like California, New York, and Maine. The other thing that has happened this year is previously in the state of Massachusetts, if you file the return jointly for your federal return, you did not have to file a return jointly in the state of Massachusetts. This has now changed. You are now required to file jointly in Massachusetts if you filed jointly in the state, if you filed jointly for the federal return. And thank you very much for listening to me. I'm going to pass this along to Rob, who's going to give you information about estate taxes.
Thank you, Mary. Hello, my name is Rob Aroni, and we're going to talk a little about estate taxes today. And I just want to talk a little bit about, obviously, the election that happened a few weeks ago and what the potential changes could look like. But I also always want to remember that we still have to always think about estate planning as who gets what when. So we've been very, very busy basically from this summer going forward to the end of Q4, and looking at 2025 was going to be very busy because we thought that the federal estate tax exemption was going to sunset at the end of next year. So now that the makeup of Congress and the presidency is basically the red trifecta, we're still trying to figure out what is going to happen. So let's go back to some of the basics. And on the first slide, I want to just talk about what the annual exclusion is for 2024, and that is $18,000 per person. So husband and wife can each give away $36,000 to anyone tax-free without using up their basic exclusion amount of $13,610,000, which we'll talk about on the next slide. Next slide. So in 2024, the federal estate tax exemption, again, is $13,610,000, and IRS just published the numbers for 2025, which is $13,990,000. And again, it's supposed to sunset to roughly about $7.2 million in 1/1/2026. So if Congress doesn't do anything and there's not a tax law change, it will sunset. We now have to wait and see what's going to happen when President Trump gets sworn in, and what's going to happen with the House and the Senate, and if they're going to extend this bonus exemption of the 14 million, in essence, further into 2026, and for how long. I think they're going to have to figure out how we pay for it. Next slide, please. So this is just a slide that shows you, no matter what happens with the federal estate tax exemption and gifting, that everyone really should start off with, a basic plan, a will, a trust, and a power of attorney, and a healthcare proxy. Then from there, we ladder or layer on different phases, and we use other estate planning mechanisms, whether it be a GRAT, a family limited partnership, or other tools in the toolbox that we'll talk about. SLACS, which is a spousal lifetime access trust, has been very, very popular lately. And I think we're still going to continue to see that with the ultra wealthy clients to take advantage of the exemption. Next slide, please. So again, back to the basic estate plan, everyone should have a power of attorney, a healthcare proxy, and an estate plan to talk about what you want to happen and who you want to name as fiduciaries, your personal representative, the old term, the executrix, trustees. And if you want to further your charitable goals, you need to enter or draft the charitable dispositions in your estate planning documents to make sure that if you were giving during your lifetime and you want that some of it to come out of your estate, you specifically name the charities. Next slide, please. So most of our estate planning clients always have, if it's a husband and a wife, a revocable living trust. And that really becomes the centerpiece of their plan. And when, in my example here, if husband were to pass away, these sub-shares get created under the husband's revocable trust. And in Massachusetts, which we'll get to in a few slides, now has recently changed their law and increased their exemption from 1 million to 2 million. And the other two trusts would be what's called the Massachusetts Marital Trust. And if we were over the basic exclusion amount of 7 million, would have a federal marital or Q-tip trust. Next slide, please. So some of the things that we've already talked about is that I do believe if we have the financial ability and we're in a client has a taxable estate, we should be making annual exclusion gifts. And those round up per 1,000. So it's 18,000 this year. It's going to round up to $19,000 next year. So that does not reduce your basic exclusion amount of roughly 14 million. So it's another way to reduce your overall estate while not using up any taxable gifts. So I think those are always smart to do if you can. And then more importantly, the beneficiaries don't have to wait until you pass away to help them along the way. I mean, most of these gifts are going to children or other family members, and they'll get a little help along the way. The other big thing that's been very popular is the spousal lifetime access trust, where in essence, husband and wife each create a trust. They want to take advantage of this high exemption of $14 million next year, and they each make gifts to a irrevocable trust where their spouse is a beneficiary, so that they have, in essence, indirect access to the funds. And a few other things that have been very popular, which is still very important. If you own a lot of life insurance, you really should never own it in your own name. You should own it in an irrevocable life insurance trust to keep the death benefit out of your estate for federal and Massachusetts purposes. So that has always been a staple in traditional estate planning, and even more so with our Massachusetts estate tax of only 2 million. We're one of the few states, even though we've increased our exemption from 1 to 2, that has a separate state estate tax, which is still relatively quite low. Next slide, please. Another popular technique has always been a GRAT. And I won't get too technical, but the point of a GRAT is to place property into an irrevocable trust and in essence try to outperform the Section 7520 rate, which is roughly about 5% right now. And anything that you any asset you put in there that is increasing greater than that, you move that appreciation outside your estate. One of the things that Senators Wyden, Warren, and Sanders were always talking about doing was trying to whittle those away, get rid of GRATs, or have a minimum term. Right now, there's no minimum term. So I think that while the president is all red for now, that is not probably going to be touched, but could be touched in the future by different administrations. So I think we're still proceeding along with a lot of GRATs. The interest rates have obviously creeped up a little bit, which makes them not as attractive as if it were a low interest rate. But for most people, they can still beat the hurdle rate, and we are still doing a lot of GRATs. Next slide, please. I think there are a variety of reasons why clients need to act. And a lot of times it can be as simple as they're going on a trip. All of a sudden, they've made plenty of trips before, but they're going to the airport and they want to make sure that they have their will and trust in place. And a lot of times things happen in life and clients get divorced and we need to redo their plans. Or they own a privately held company and they're ready to, sell that company and they want to take advantage of some gifting to move some of that appreciation out now. And the big driver, again, that's been keeping us very busy was the prospect of the federal estate tax sunset. I think some of the clients maybe will take their foot off the gas a little bit just to see what's going to happen or what's going to be proposed by the House and the Senate and the President. But I do think that for the ultra wealthy clients, and I say that, that's a subjective term, but we view it as in relation to what the federal exemption is. So if it's north of 28 million, the plan is still proceeding as is, because the exemption is probably never going to be this high again, or if it is, it might only last another 4 years. So those clients are proceeding as planned, and they're still making large taxable gifts to get obviously the appreciation out of their estate. Next slide, please. So I just put the 13.6 in a graph just to show you that where we are right now in 24 and where we'll be in 25, and you can see how much it gets cut on 1/1/2026. It literally will be cut in half. So that is the sunset that Mary and Prasanna talked about with a lot of the individual income tax pieces. And this is the estate tax side. So now we're all waiting to see if it will be extended. And all the seminars are coming out. The people are talking about it. We just don't know yet what they're going to propose, whether it's going to be more income tax benefits, because that's immediate for taxpayers to get the relief versus the estate tax of passing away or gifting. And more importantly, how they're going to pay for it. So we'll see what's going to happen in the next couple of months and what's proposed. Next slide, please. I think no matter what you need to do with your estate plan, you honestly really have to have a good team. And I think, it's invaluable to have a top-notch CPA. In my prior life, I was a CPA. They add so much value, and you should be working with your CPA not as a historian, but looking prospective. If you're going to do tax planning, whether you're selling your company or doing other things, have them run projections, work with them to make sure numbers work about making gifts that they're enough to keep your lifestyle still in place if you give away a lot of assets. And it's the same that works well with your wealth advisor. So it really is a team effort, and to build the right team to get you, the clients, the right advice. Next slide, please. I want to talk a little bit about some changes on the Massachusetts estate tax. Next slide. There was some big changes last year that we finally increased our estate tax, quote unquote, exemption from $1 million to $2 million. And they made it retroactive to 1/1/2023. The law passed in October of 23. That was a big relief because it's been like that for 16 years with no cost of living adjustment. And also, we'll talk about it, but the way they calculated the tax change, which was beneficial to the taxpayers. Now, they gave us some estate tax relief, but then they also passed the millionaire's tax, which increased the income taxes by an extra 4% on someone earning over $1 million. So net, they gave us something, but they also took something away for those that are high income taxpayers. Next slide, please. So this just simply shows you that if you passed away in 2022 under the old law with a $2 million, you were single, assume there's no spouse, the $2 million taxable estate, you would pay almost $100,000 in Massachusetts estate tax, versus now under the new law, you would pay $0 in Massachusetts estate tax. And that is a big difference. So if you're right on the cusp with a $2 million estate, you're now saving $100,000. And the next slide, we'll talk about how they changed calculating the tax. Next slide. So the old law used to be what's called a cliff exemption. So if you were $1 over $1 million, you would pay a tax from $0. So in our example here in 2022, if you were $1.1 million, you're $100,000 over the quote unquote exemption, you pay almost $39,000 in Massachusetts estate tax from $1. The new law, it really is more like the federal law. It's a true exemption. So if you had a taxable estate of 2.1 million, you only pay tax on the $100,000. The 2 million exemption is a then the tax is based upon $100,000. And you can see the difference. Now I'm only paying tax of $7,200. So they've made it from a filing requirement really to a true exemption like the federal exemption. Next slide. They also changed in part about prior taxable gifts, not annual exclusion gifts, actual taxable gifts. Under the old law, you would add back a prior taxable gift, and that could affect the estate tax overall. So if you had a $950,000 estate and you made $100,000 of taxable gifts, you are actually, for filing purposes, since you're over $1 million under the old law, you are actually paying a tax on the $950,000 estate, even though the $100,000 isn't taxed. It puts you into the filing requirement, which would you then pay a tax. They cleaned that up under the new law. So now under the new law, taxable gifts do not affect any filings at all. So you would not pay a tax. So if you had $1,950,000 and you gave away $100,000, you're only taxed on the $1,950,000 and you'd owe zero in tax. So that was a nice bonus for the taxpayers too, not to add in the prior taxable gifts and pay a tax. And the next slide, I just want to remind everybody that many times you have to file in Massachusetts estate tax returns because it's a filing requirement. So if you're married and you're over the $2 million gross estate, you need to file the tax return, which clients always ask us to the CPAs have to file, to the trust and estate lawyers have to file. One of us are going to have to file for you, but there won't be a tax due because A, you'll either have a marital deduction, or B, you'll have some expenses that reduce your taxable estate to something that's below the amount they're actually going to pay tax on. And they also changed back to our out-of-state property. So if you're a Massachusetts resident now with out-of-state property, that is not going to be part of the tax calculation. So we've had some returns that just came out about a month ago that we filed that we're looking to see whether we may want to amend those 23 returns or 24 returns that we filed to get a refund, because when they first changed the law, they were including out-of-state property as part of their tax calculation in the regulations. They subsequently amended that, and now they went back to 1/1/2023. So we're talking to a few clients that we may amend the returns to request a refund for overpaid taxes. Clients are happy about it. They're not happy about paying for the amendment, but overall their net is going to be greater because we're going to be getting a refund with some interest. And with that, I'd like to bring it back to Marty for any questions that anyone may have for the group, and we can go from there.
Excellent job, team. Excellent job. We've got about 10 minutes left. If you look at the bottom of your screen, you'll see a Q&A box. If you want to type in a question, no one will know that you wrote it. Just write it and we will try to address them. In the meantime, there's a couple of questions here. So let me see what we got. First one is, how do I get that IP PIN from the IRS? Do I just go to the IRS website or something, Mary?
Yes, it's really easy to do. We could send you a link to the IRS website. You could apply online through the IRS website. It's actually, they'll send you to ID Me and you do it through there. And if you're not computer savvy, you can always still do it the old-fashioned way. There's a form that can be filled in, but it's really, I did it at like at 11:30 at night because I was freaked out after my identity was stolen. And within 10 minutes, it was done. It is quite easy to do.
Excellent. If it's a married filing joint, does each taxpayer have to have an ID number?
No, you don't. You only, you should, because I had a friend who actually, her identity was stolen and a return was filed with her being a spouse to somebody else who actually also had his identity stolen. So you have two different people who don't know each other. A fraudulent return was filed for both of them being married to each other. So yes, each person should. And the IRS is recommending everyone obtain an IP PIN.
Okay. A couple questions about the beneficial ownership form. What happens if you don't fill it out? Are there penalties?
There are penalties. I don't really, off the top of my head, know exactly how much those penalties are. I think they are hoping that if you get it done, they're going to be a little bit more lenient. Let's just get it done. It really is an easy process to do it online.
Okay, second question there. Are S corps covered by this beneficial ownership rule?
They could be, yes. If they're an LLC that has elected to be an S corporation and they are under the threshold of number of employees and gross income, yes, they will be, they will have a filing. If you're
Okay.
unsure if you have a filing, please reach out to us. We could go over your exact scenario. And like I said, the website does have a very nice video that explains everything. And it also, the FinCEN website has a nice question and answer document that goes through all kinds of scenarios. And it may, your question may already be answered in their Q&A document.
Great, thanks. Question, Prasanna, about the reconciliation process that you went through. Could you kind of run over that again?
Yeah, so the way it works is that if you are trying to give some sort of tax cut, you got to figure out a way to either reduce your expenses or generate more revenue within a window. It's usually a 10-year window. So if you're giving somebody a tax cut today for $1 trillion, you got to figure out how to get $1 trillion back into the revenues within this 10-year window. So all of the Trump's tax cuts or tax reform extensions um, is is going to cost a lot of money to the exchequer. So they're going to have to figure out how to get some of that money back so that or reduce expenses in some other ways in order to kind of keep it revenue neutral over the 10-year window period.
Got it. Rob, you went over this briefly, but now that the Republicans have won, are you still going through the planning process with people now, or are you waiting to see where the shoes drop?
So that's a good question. And again, I think you always still have the basics, and it sounds crazy, but who gets what when? So we always need a basic plan. And I think that the gift tax and the bonus exemption sunsetting is one piece of the plan, right? There's income tax planning, there's, incapacity planning, there's asset protection planning by making gifts for non-tax reasons to entities, for creditors. So I think that for the ultra wealthy clients, meaning again, over the 28 million husband and wife or over 14, we're proceeding as is. I mean, we make the taxable gifts now and all that growth is outside of the estate. For the clients that are below that amount, we're going back and looking at what the other reasons are. And they're taking a little breath. They're saying, okay, let's get through Thanksgiving. Let's get through the end of the year. Let's see what Q1 looks like after the president is sworn in, and let's see what their proposals look like. So I think that the rush that we had is a little bit slower than before, but there are still so many other non-tax reasons to continue to make these gifts. So I think the answer is ultra wealthy, they're proceeding along, and B, in the middle, they're taking a breath for the next couple of months just to see. As one client called me and told me and said, I have another reason I can procrastinate now. I'm not in the hurry that I was before.
What's your best guess at when we'll know when this final lifetime exclusion, gifting, all that kind of stuff is going to be settled?
So, I mean, we always have to remember that the law on the books is it sunsets. So if there is no action, it sunsets on 12/31/2025. So there has to be some tax law change that the group, right, the president, the House, and the Senate can agree on. And back to kind of Prasanna's point, how do we pay for it, right? There's going to be some type of trade-off, whether it be income taxes, SALT deductions. To me, it's easy for any party to say, I'm not going to change anything because the law is already there. It's going to sunset. Maybe they come up with an agreement where they get greater income tax benefits and punt on the estate tax. We don't know yet. So I'm hoping by Q1, Q2, when the proposals come out of, you know, the subcommittees of what that looks like and where people are going to vote.
Great. Thanks, Rob. Here's one about inherited IRA. Inherited IRA by non-spouse for decedents dying after 2020. The IRS waived the RMD through 2024. Are RMD required for 2025?
Yes. So that's under the Secure Act. That's basically the 10-year rule. If they're not considered an eligible designated beneficiary, it's not a spouse, we're not rolling it over, they're stuck with the 10-year rule. So they waived the penalties for the last couple of years. They just came out with their regulations over the summer. You will have to take an RMD for 25 and empty that IRA by the 10th year.
Okay. I have an inherited IRA, and my investment advisor will not calculate the RMD. Can Stowe Degon help me with that?
Of course, we can help you with that.
Yeah.
But there is wonderful calculators on like Charles Schwab
Okay.
and Voya, that if you put in the information correctly, that those calculators can also calculate it for you.
All right, great. Well, let's take one more question. Should a life insurance policy having accelerated benefits still be owned by a trust?
So that's a good question. And the answer is, like most lawyers would say, it depends. Is there a taxable estate? Is the beneficiary a spouse? Are they over any mass estate tax exemption amounts? So I think the answer, it depends, right? If they're over a taxable estate, their policy should not be in their own name anyhow. It should be outside the taxable estate in an island.
Excellent. Well, that's all we have for Q&A.
I think,
Oh, go ahead.
Marty, there's a couple more questions here that just came up.
Oh, okay.
One of them is, with the new estate laws in Massachusetts, how does one spouse passing on 1/1/22 and the other is still living impact the changes in law?
So 1/1/22 would be the old law and would have to obviously see what their estate plan document said, but there's still the unlimited marital deduction. So once we reviewed their will and trust, if they left everything to the surviving spouse, there would not be an estate tax.
Okay. The last question here is, does the elimination of the New Hampshire dividend and interest tax in 2025 apply to trusts? I believe it does. I think they're just getting rid of the whole dividend and interest tax altogether. We can double check that and confirm that, but I think that's the right answer.
Thanks for catching those last couple, Prasanna. Thank you all for attending today. We really appreciate you attending. You will get a survey, as we talked about, if you could fill that out quickly. As I said earlier, this program has been recorded. It will be loaded on the Stowe Degon Zoom account shortly. And if you wish to get a copy of this webinar summary of the video, please contact your contact at Stowe Degon and we'll take care of that. Want a special thanks to Rob for joining us today. Prasanna, Mary, and Rob, you all did a great job, and on a very difficult topic, so on a very important topic. Enjoy the rest of your day, everybody, and remember, before you make any big decisions, please contact us. See you later.